The starting point is that global warming is caused by carbon emissions. Let's keep things very simple. And carbon emissions, therefore, are a negative externality for the world because they cause warming, and the warming causes lots of bad things, including economic damages. And then the question is, from an economist perspective, how do you internalize that externality? And economists had a very simple way of thinking about this, which is you need to price. The clean air is a, if you want, a right for humanity. And if you want to pollute clean air, you have to pay for it. And then you have to pay how much? Well, whatever harm the pollution causes, and you have to pay that price. So that's the simple economic analysis in general terms. We wish we could just do this, end of story, but we're not. And that's why I think we're here, because it's not being done. And then the question is, well, can you act while the problem is being ignored and not being addressed in a way to reduce the damages? And if so, how can you act? What can you do? And this is where the financial sector and the private sector comes in. They realized governments are not moving fast enough, so it's up to us to find ways to substitute for the lack of government action.
Great, and I'd say I kind of start where Patrick left off, which is that my work is focused on how can we create these incentives to reduce emissions. And first of all, there's a political problem. This is governments, the private sector can't really solve it on its own. It requires the government to act, and it's not even that simple, because it's really a global governance problem. And so how do we get all governments around the world to act together and coordinate and harmonize the creation of these incentives? The problem historically has been a little bit political, because the act of pricing carbon makes goods more expensive, and so consumers don't like that, and so they react negatively. The benefits from pricing carbon are in the distant future, they're uncertain, and so it's easy for those whose interest is to prevent the pricing of carbon, and of course some people benefit, some people are made worse off, to create the barrier to convince voters that this is not in their best interest. And voters tend to be a little bit short-termism, so they put more weight on what happens sooner rather than later. And so one approach that I've proposed is to create something I call a carbon-linked bond. And the idea of the carbon-linked bond is really quite simple. Rather than pricing carbon immediately, the government would promise to price carbon and raise the price over time. And then in the context of a bond, you can link the coupon and principal to the actual price of emissions. So this is really taking an idea from real return bonds. In the US, they're called TIPS, Treasury Inflation Protected Securities. And we can use all the same benefits that arise from the inflation-protected securities. One of those benefits is that when you look at the price of the security, it reveals what the expected future inflation is going to be. It's called break-even inflation. By making that transparent, another benefit is that the Federal Reserve, the government, can now see what is the expected inflation, and it can react to that. And by reacting to it, for instance, recently the Federal Reserve saw that expected inflation was much higher than its target 2%. It said we have to raise interest rates and slow down the economy and reduce these price pressures, and it has done that. And it has done that very successfully in the last few years because it has a lot of credibility. So when it says we're going to move, the market believes that, people react, and the inflation comes down. That credibility is very important when we talk about carbon pricing, and the same thing can happen. So if the government now promises that we're going to increase the price slowly over the future, that does a number of things. First of all, you don't have the immediate reaction that, oh, my prices are going to go up. Number two, it reveals what the market's expectations of inflation, not inflation, in this case, carbon pricing, are going to be. And number three, it provides an opportunity for investors or entrepreneurs who want to hedge against the risk that the government doesn't actually price carbon where it says it's going to hedge that risk. And so all of those things should allow entrepreneurs who want to get paid for reducing their emissions or actually pulling CO2 out of the atmosphere to reduce the risk of that actually happening, of getting paid. And so hopefully this will create incentives for the development of these harmonized prices across different countries. Now, when I say all this, one of the issues, let's say in the United States, is if the government were to promise to price emissions in the future, I think you might find that people don't believe it. You might see that this is not realistic. That wouldn't be very helpful. But so where you want to start is with governments that have a lot of credibility, and there are many governments around the world where if they say we're going to price emissions at this point, obviously there's already governments doing that in Europe, for instance, and other countries. But this way you could increase the number of governments because you wouldn't have the same political reaction.
For that, I think it's helpful to backtrack. In fact, I've known Bob for a long time, and Bob gave a very important talk in 2010 linking the financial crisis that we had just lived through to the coming climate crisis, and linking it to the same underlying causes, which are mispricing of the risk encourages building up the risk until we face a crisis. That talk and the research that was done after has had ripple effects. One of them was that at the Paris Agreement in 2015, which is a very important milestone, for the first time, you had included in the Paris Agreement the financial sector. And you had the Portfolio Decarbonization Coalition, which was created with the UN, putting the issue of what the financial sector and what the business sector will do on the map, along with governments. The other important development from the Paris Agreement is that suddenly countries were taking it seriously. So you had pretty much the whole world sign up to the agreement, and you had many countries making ambitious commitments, and these have been now updated in the form of net zero commitments, like the UK 2050 net zero commitment. It's a legally binding commitment. You have more and more countries doing this. You have over 130 countries in the world making net zero commitments. There's a long way from here today in 2024 to 2050, but there's a goal. There's increasingly a roadmap that's being made clear, and that's where initiatives like what Bob mentioned suddenly come to life, because it's not no longer an illusion to think that we will start to price carbon in some form, and that therefore you can start leveraging the financial sector to build on these promises, on these commitments.
And I would just add to that we're already moving. If you look at the amount of investment today in low carbon capital and infrastructure, Bloomberg New Energy Finance measures this, and they estimate there's about 1.8 trillion that was invested last year, which is a huge number, and it's been growing rapidly. Of course, it's not enough, and that we're not really on track to get to net zero by 2050, and that's an issue. But what you see is of that 1.8 trillion, much of it is government subsidies, and a lot of it is philanthropic money. What we really need and have not yet achieved is the private sector, incentives to profit. And so that's what we've got to do. That's where we've got to raise those prices where they exist and get pricing going where it doesn't yet exist. And as Patrick said, that's happening now around the world. We need to accelerate it. I would say the U.S. Is really far behind. China, the biggest polluter, has not yet done a great job of it. So the big polluters are not yet on board, and that's a problem. But I think that's going to happen very soon.
Yeah, and so on the if I can take where you left off. So on the incentives part, how can you incentivize decarbonization? One instrument that is at the center of the answer to this question is carbon offsets. And carbon offsets come in the form of carbon capture through nature-based carbon sinks, but they can also come in the form of avoided emissions. And if you can monetize avoided emissions, that's a financial incentive. That's, if you want, the counterpart of a tax. A tax is you disincentivize emissions. Carbon offsets for avoided emissions is you incentivize decarbonization. And there we see lots of potential for increasing these incentives, because you have, around the world, you have mandatory emission trading systems. The most advanced one is in the European Union, but you have such systems in other countries. And then you have the voluntary carbon offset markets that are really taken off. They're being standardized, they're being set up institutionally so that the offsets are credible, and you will see an explosion of these markets globally, and that's going to be a substantial financial incentive for the private sector to decarbonize.
Well, I think there is an agreement with respect to these carbon markets, the offset markets, that it needs government regulation. And so, for instance, in the United States, the Commodity Futures Trading Commission is now, it's had a number of hearings, and it's clearly moving toward creating basically a focus on carbon flux, I call it, the movement of carbon out of the atmosphere into landscapes, as being a commodity with standards and a self-regulatory organization. And so just as with any other commodity like corn or wheat, it's well-defined, you can trade it, you don't worry about the quality. We don't yet have that in the carbon offset market, but that's the direction we're going with government oversight. And I think that will make it much more of a real market. And it is the cheapest way really to reduce emissions. And so as an economist, you want to create an appropriate incentive and let the private sector react to that and make all the decisions that make sense in a decentralized way. So that's clearly where we're going with respect to these carbon markets.
If I can add to what Bob said, and in answer to your question, if you want the way forward, the big picture way forward, is you need the public sector, public money to leverage private money, the private sector, because the public sector can't shoulder on its own the costs of the energy transition. But it's possible to leverage the private sector. And I mean, that typically comes under the wording blended finance. And blended finance, one way of understanding is you have a first loss piece that's public, and then you have the second loss piece that's private and has been de-risked by the first loss piece, and that then brings in the capital market investors. The other part where you can combine public and private money is you can use the carbon offsets or the promise of future carbon offsets based on future avoided emissions as a source of either collateral or funding. And so the point is, and this is what I'm going to talk about this afternoon, is that by making funding for renewable energy development conditional on phasing out a fossil fuel energy facility, you can now leverage the potential financial resource that comes from the avoided emissions, and then suddenly, you know, things start looking much more feasible. So that would be sort of my one way of answering your question. You know, in economics, your first introduction to economics is, okay, so you have production, consumption. How do you produce? Capital and labor. That's a typical description. Nature is absent. There's no land, no natural resource, no energy, nothing in our models. We can no longer do this. We have to now, you know, be real. Say, no, you have to include energy, you have to include nature, you have to include the fact that the planet can only absorb so much pollution. And then you have a much richer, much more relevant economic analysis. And that's why it's so important to have events like this, because, well, if you want to include nature, if you want to include energy, you have to talk to people who understand energy. You have to talk to ecologists, meteorologists, as we heard yesterday, and climate scientists. It's all part of the package. You can't separate any of these pieces.
Yeah, and the only thing I would add, I totally agree, is that this is the essence of the problem, is we haven't measured or recognized the benefits from nature. One of which is carbon sequestration, but biodiversity, clean water, just all of those. And as long as we don't recognize them, we're going to always, use that land for something else. So that's the fundamental problem. But again, I think this has been a great conference because it is so broad, and you bring in these different perspectives. Although I don't know how you feel, Patrick, but at the end of the day, the economics and the finance is we have the solution, we know what to do, and we just have to get over the political constraints. And I think we're getting close. There's a general recognition now, and what makes it so hard is the lack of a global governance structure that can actually implement a solution that we know exists.
Bob, in your previous career,
yes,
you were an investment banker.
Yes.
And investment bankers is all about making deals,
yes,
making them happen. So that's our comparative advantage. We can turn to government and say, here's a deal that is possible that we can make happen. And I think that's another I think, plus that we can offer.
Yeah, I mean, at the end of the day, we all live on the same planet. So, there's no planet B. And the focus on uncertainty in this conference is important because, we don't know, there may be tipping points out there. You know, there's a lot of uncertainty, worst case scenarios out there that we really have to take seriously. And so it's a risk management problem. And, you know, time is a scarce resource. If we have enough time, we can solve any problem. But the question is, will we react quickly enough in this case? And so that's why we have to get those incentives in place ASAP.
A word on geopolitics at the moment. I think there's a lot of pessimism because climate has been politicized in the US, for example, and things could have been done that have not been politically feasible. There is the widening rift between China and the US prevents more cooperation, in global cooperation on climate policy, and so on. So there's a negative mood at the moment. It's been worsened by the aggression of Russia in Ukraine that has caused an energy shock. And if you put these two things together, maybe on a more positive note, maybe you can see that we might have overreacted to the negative news. The energy shock that was caused by Russia's invasion of Ukraine is not going to be permanent. It's a temporary shock. We're going to revert back to normal. And at that point, I think there's going to be new appetite again, new political support for the climate transition. Costs will go down at that point. So this is, again, where uncertainty comes in. There's uncertainty, and then there is the sort of like the, you know, how we respond to it and how we respond to shocks. And we tend to, and that's a behavioral side, right? We tend to sort of emphasize shocks in the short term. But we should be aware. There's a lot of mean reversion, and so maybe that's where I would end on your question.
Yeah, I don't know if there's, I would say in the short term in the United States, and the United States is a very important player here and has been a blocking agent globally. There are tax cuts that are going to expire next year. And so there's going to have to be a new source of revenue. This is an obvious source of revenue.